Hello, welcome to today's video. The topic of today's discussion is valuation of bonds and shares. What are bonds and shares? For when the company needs fund, there are two sources available to a company that they can either issue bonds or one can say debentures or they can even issue shares. So on bonds and debentures, the company has to pay a fixed rate of interest, whereas in the shares, the company pays dividend, and the rate on dividend is not fixed but it is fluctuating in the case of equity shares holder, but in the case of preference shares the rate is fixed. So let's discuss the case of bonds and debentures first. In the case of bonds, two parties are involved in this. First one is the company, or one can say the issuer. Issuer means the person, the company, the corporation, or the government. It can be the government who issues what? The bonds. Who issues, or one can say who sells the bond. The another party is the bondholder. One can call him the bondholder or the investor who has enough of money, who has one can say who invest his money in the corporation, or the purchaser of the document. One can call this party with these terms. Okay, so what happened that the issuer or the corporation sells the bond, or one can say the investor purchase the bond. Both are the same thing. And after that the company issues bonds is a document. It is a document which represent all the terms of sales, that the company is selling this much amount of bonds, the amount of bond, the percentage interest, the rate of interest of bonds, that on bonds the company will pay this much amount of interest, this much amount of bonds, quantity of bonds, terms of bonds, that is the time period for which the company is issuing bonds, everything is mentioned. And the bond holder or the investor will purchase this document, one can say, because in physical form only the bond document will exchange. And in place of this document, the bond holder or the investor gives money to the company, and on this money the company pays fixed interest rate at a fixed interval to the bond holder. Okay, so one can say fixed interest rate is being paid at a fixed interval. It can be quarterly, it can be semi-annually, or it can be annually, whatever the term of bond is. And after the maturity, that at the time of maturity, what will happen, that the company or the issuer will repays the amount, that after using the money, say the term for money is 5 years, that after 5 years what happened, the company repays the amount to the bondholder. That bondholder will show this document to the company, will go to the company and show the document he is having, and will get the money. So the company will repay the amount to the bondholder. So the value that he will pay, that the value at the time of maturity is termed as that is par value. Par value. The money which the company pays is termed as par value, whereas the value or the money which the holder will pay or the investor will pay is known as face value. Okay. So the value the company receive, one can say the value which the company receive at the time of issuing the document is termed as face value, whereas the money which the company pays to the bond holder is termed as par value. So par value can be more than the face value, or it can be less than the face value. If the par value is more than the face value, it means the investor is getting more as compared to whatever he pays to the company. And if the par value is less than the face value, that is if par value is less than the face value, it means the investor is getting less than the whatever he pays to the company. But in the case of par value is less than face value, it happens when the company is selling its bond at a discount. That is, at a discount, at a very no, that on selling the shares, the company gives discount to the investor. So the company receive less value, and at the maturity the company is paying more value. Whereas if par value is less than the face value, it happens in the case when the company issues its bonds at premium, at a premium. That is, the one can say the goodwill of the company is very high, or the company the value, the stock, or one can say the bonds value of the company is high, so the company sells its shares at a premium, and at the maturity it pays only the face value. So it happens that in that case that par value becomes less than the face value. So these are the bonds. So valuation in bonds or shares is a fundamental aspect of investing in finance. So what happens that in the case that this is the first principle, that to value of security, first principle says that valuation of securities is equal to present value of expected cash flows. Valuation of security means you have to calculate the present value of expected cash flows. So what are the cash flows? Cash flows are your interest payment, that the on bond you will get some fixed interest payments, so you have to calculate the present value of interest payment that you will receive in the future. It may be annually, it may be semi annually, or it may be quarterly. Okay, so these are the interest payments the investor will receive, and investor has to but convert it into the present value to see whether the investing in bonds is worth or not. Another cash flow is the par value, or the value which the investor will receive after maturity. So these are the total cash flow, that is interest payments and the par value, or the value of bond. So the investor has to see its present value, its value in present, because the basic principle says that the rupee 1 that you invest today is worth more than the same rupee that you will receive in future. So you have to convert it in present value. You have to see the worth of the money that you will receive in future in the present term. Okay, so there is a cycle. One can say the process of calculating of valuation the bond is method to calculate. Valuation of bond is a method to calculate the present value. One can say valuation of bond is a method of calculating the present value of future returns or cash flows. So one can say that it is a method to calculate what? The present value of expected cash flows. What comes under cash flows is your interest plus maturity amount, or par value, maturity amount from a bond, expected from a bond. How much you will get from a bond at a future date, you have to convert it into its present value. Who will do this? By a potential investor, by a investor. One can say that an investor will do all this calculation. Who weighs? Who then? What will we do? Who weighs the cost, that the cost he is incurring in return, the cost with returns. He will compare whatever he is paying today with the return he will get in the future, and this is a method in which he compares whatever he is paying, that is whatever he is posting today, and compare it with the returns that he will get in future, returns in future. And if the return is more than the cost, then he will accept the proposal. If return is more than cost, he will accept. Otherwise, he will reject the proposal. He will not go with buying the bonds rest, or one can say he will go to any other investment proposal. So, valuation and bonds and shares is a fundamental aspect of investing in finance. It involves determining the fair value, intrinsic value of financial instrument, which helps investors make informed decision about whether to